How's it going, everybody? It's in the money. This might be the first time you see me in contacts, which might be a little bit upsetting. It's usually off-putting for some people, but that's good because my goal here is to chip away at every last bit of humanity you have left until the last mote of your soul falls away into the infinite abyss and never comes back. And you are just a shadow of what you once were. Why else would I start a channel revolved around options trading? Now, that said, today we're talking about implied volatility and how to find implied volatility because it is really freaking hard to find. I'm not going to lie to you. Even paid sources look like crap. I wish TradingView had it, but their proprietary coding language, PineScript, is just limited. So let's just jump in and show you how to get implied volatility. And we're going to do it through TD Ameritrade, which is not optimal, but it's just how it is. I can't find any other source. If you have a better source, please link it down below. But what we're going to do, I forgot what my buttons do here. What we're going to do, don't mind this stuff. I've been like doing all sorts of technical garbage. We'll do TD Ameritrade paper trading. And I'll link this down below. We want to go to register for paper money. And what you're going to do is you're going to enter all the information it wants you to do. Do you have a TD Ameritrade account? Yes, no, maybe so. And then you fill it all the way out. It doesn't even ask for your social security number, so it's not like opening an actual brokerage account. But it gives you the benefits of their platform. So once you've filled all of that out, you're going to download Thinkorswim. And I've already done that, so I'll just open up Thinkorswim really quick. Okay, so I lied. I didn't download Thinkorswim. I thought I did. But I'll link this below as well in case you have trouble finding it. It should lead you right to it. But you can download Thinkorswim for the desktop, which is just their trading platform. And you can paper trade using Thinkorswim. That's the whole point of this paper trading thing, is to allow you to paper trade. But that is not what we're going to be using it for. We're just using it for implied volatility data. Now, you could use something like IV Rank by Tastyworks, which is a good metric for our buying and selling options based on implied volatility levels. However, I just personally like to see like the average of implied volatility of options on the options chain of an underlying plotted out across time. I just like to see it. That's what I like to see. I don't like to see IV rank, although other people might disagree. It's a simpler metric, really. Above 50 sell, below 50 buy. But I just like to see where IV is relative to its history as a chart. And that's just me. So now we've got this downloaded. We can boot her up. And I'll get back to you when we hit the sign-in process. All right, I finished downloading Thinkorswim, and every single time it's going to install updates, which is either it's actually installing updates or it's just looking for updates. But eventually it'll bring you to its login thing, and you can just pin this to the taskbar. So go down here, right click, and just pin to the taskbar. So you always have it ready to open whenever you want to take a look at implied volatility. Once you hit this point to log in, you should know your login information, but be sure you switch it over from live trading to paper money. If you don't have an account with TD Ameritrade, live trading will do nothing, but if you do, it will trade live, so you wouldn't want to do that. So let's switch over to paper money because that's what we are registered for, and that's what our login is going to be used for. Mine's in the money paper. We'll put our password in really quick. I'm obviously really defensive of my paper money. Such a long password. This starting out part is kind of the most labor intensive, and then it'll just be easy from here on out. Come on, baby. Oh, yeah. I was trying to say, come on, baby. All right, so you can customize this a lot of different ways, and there's plenty of tutorials. I have my own Thinkorswim tutorials because I've used them plenty. We're going to up the font size really quick here. So be general look and feel font size, very large. And I'll try to keep in mind what you can see because I have an ultra-wide monitor. But you can see you have buying power, option buying power, and stock buying power, net liquidity, forex, cash and sweep vehicle. You can actually paper trade. And when you enter a trade on this platform, it'll change the values of that money. But we're not here to do that. We want to do one thing first. We want to go to our chart settings in the top right. Okay. And it's going to be a little blue cog in case you can't see it. And we're going to do overlap volume down here in kind of the bottom middle. Hit apply. That's going to put the volume on our chart, which is really nice. So it's not, basically two charts. Now we want to overlay implied volatility. So I can hit Control E, which is edit studies, and studies are basically indicators. And we want to type in imp vol. And once we do, we double click it. We can customize it by hitting this cog here. I like it how it is. Maybe I'll change the width to 2, but you can change the color. You can change what the line looks like, etc. And then we hit OK. We hit apply and OK. Now look, we have historical implied volatility across time. We can see if it's low or high compared to its history, which is kind of what IV Rank does, but I just like eyeballing it and seeing where we're at for expanding or contracting. And you can see we've been contracting in implied volatility, at least for the ticker AMD. Move over a little bit if you can't see it, AMD. So there'll be different implied volatility for different tickers, right? If I hit Apple, it's going to be a little different. They're going to be similar, especially in similar sectors, but maybe you do Coca-Cola. That's a little different than what we're looking at with Apple and AMD because it's in a different sector. But let's go to AMD really quick. So we have implied volatility. That's great. We have a nice little chart, which is also helpful. I prefer TradingView's chart. It's much easier to navigate, but this is a good tool for implied volatility. But it's something to look at like every once in a while. To see whether you should be buying options or not, because you wouldn't really want to be buying options up here. The reason being is implied volatility basically just expands the price of options. It's going to increase extrinsic value, which is what you're risking above holding 100 shares. If you take a look at an option and you look at its extrinsic value, which you can actually measure, you take the current stock price minus the strike price if it's a call, and whatever's left over is extrinsic value, time value, that would decay to 0 by the time you hit expiration. The higher implied volatility is, the higher extrinsic value is, because implied volatility is a measure of demand, really. It's a measure of anticipated volatility. It's extracted actually out of extrinsic value. So they're kind of intermingled in that way. But when I look at implied volatility and I see like where you're just looking at where it's super high relative to its history, I might consider, well, that's not really a good time to buy options because that means extrinsic value is going to be high, which therefore is going to raise my break even. And we don't like high break evens. We like low break evens, which is why we want to buy in low implied volatility environments. It's because the extrinsic value, listen, they always tell you, like with a call option, break even is strike price plus premium paid. But so much of that is already built in. Like if I buy a $1 in the money option for $130, $100 of that is already intrinsic value because I'm already $1 in the money. Okay, the rest of it is $33, and that's what I have to lose across time if it were to trade sideways. So you're risking extrinsic value as compared to holding 100 shares of the underlying stock. So you want extrinsic value to be low. It also makes it easier to, if you're doing leaps, buy leaps again if you need to recoup losses or roll out or whatever, etc. This all is built around the concept of mean reversion. So what do I mean by mean reversion? Well, if we turn back to the chart here, I can show you. Mean reversion is found everywhere in nature. It's found in, you might have a tall child, you might have a small child, and then you might end up with one in the middle. There's always going to be a push towards the average, right? So there's this push towards the average. So if I were to draw out the average roughly, I'm trying not to do the median, but if I were to draw the average roughly, it's somewhere around there, right? So if this has a mean reverting characteristic, let's see if it has an arrow. If I can do like an arrow. Nah, it's not as good as TradingView. Mean reverting characteristic, that means this will potentially go upwards. And that might be correlated with the decline, as it usually is. You can see with declines, like right here, the implied volatility rises because there's demand for hedging and people are panicking, so they're buying puts or Yeah. So there's just more demand for options. But in this environment, you can see that buying options, there's that edge where implied volatility might increase. So when implied volatility increases, what happens to the value of the option? Well, extrinsic value increases. So you might start out with an option that's $130, but if implied volatility increases, which is really just saying extrinsic value increases, time value increases, you're going to see the value of your option increase overall, even though nothing else changed. And that's due to Vega, one of the Greeks. Vega says what happens to the price of the option given a 1 point move in implied volatility. And so it's good to buy in these low environments because it gives you that edge where if it's mean reverting, it could go up and you can make money through Vega, and it could hedge any losses through Delta or compound gains. And it's also going to reduce break even because, again, break even is strike price plus premium paid. But really, we can think of it as current price plus extrinsic value that was paid. And so if you pay a lot of extrinsic value, your break even is going to be very high. And I like to look at oh my God, what was I saying? Your break even is going to be very high. And so when you buy with this implied volatility super low like this, that's means your break even is going to be lower across all strikes on the options chain. Now there's going to be a skew usually. I wonder if I can find that on here. Let's see if analyze. There's a way to look at I forget where it is. There's a way to look at skew, option skew. But implied volatility is not going to be even across all strikes of an underlying. That's just not the case. But it's nice to look at the average and go from there. So let's think about this really quick. So where do you want to buy options? You want to buy when implied volatility is low. When do you want to sell options? You want to sell when implied volatility is high up here. So buy down here, sell up there. And that works for sell to open and buy to open and sell to close down here. And sell to close and buy to close down here. If I'm not getting my brain tied up in a knot here. So this is a good place to have implied volatility data. Now, I want to talk a little bit more about implied volatility because I can't just leave the subject alone. I want to give you a little bit more of a visual of what it looks like when implied volatility changes. So let me grab my pen here. So let's look at an example here. And on the y-axis, we have basically any given stock price, okay, S sub 0, whatever the stock price might be. On the x-axis, we have time. And over here, we have a bunch of empty space because I'm a donut. So let's say you have an option with a low, okay, it expires right here. I'm not going to say exactly when that is, but it expires right there. It's a low implied volatility environment. Your break even might be right there. That means that your break even, and I don't mean that in the literal sense of the term because break even with options refers to at expiration, but really, break even is roughly right where you started. But your break even is going to rise over time. Let me redraw that. It's not quite right. It's going to rise linearly over time and then exponentially within the last 30 days, 30 to 45 days until expiration. So there's going to be all this room right here where you can make a loss. So you do have to hope the stock goes upwards, and that's a disadvantage compared to holding stock. But you do have price. There's a term for it. I'm blanking, but price reduction. The cost of an option is going to be significantly cheaper than buying 100 shares outright. But this extrinsic value is what you're risking above owning 100 shares. So you have to be willing to risk that much. And if you keep risking extrinsic value, large amounts of extrinsic value over and over, like buying out of the money options, which consist entirely of extrinsic value, and buying a lot of them, you are going to burn through a lot of cash really fast because that just disappears across time. So that's one outcome. Let's think about what if the break even, or what if implied volatility is higher? Let me erase this garbage really quick. If implied volatility is much higher, options are going to be more expensive because extrinsic value is higher, and extrinsic value is basically determines where your break even is. That literally is raises or lowers the bar of break even depending on what extrinsic value is, which is implied volatility. We can basically think of them as synonymous, although implied volatility is extracted from extrinsic value of options. But let's say implied volatility is high, so your break even for the same option and the same expiration might be right there, where initially it's kind of linear, and then you have this massive exponential increase where anywhere in here you can have losses. So you can see the comparison between the two. This one down here is much more favorable. This one up here is not so much. So implied volatility has to do all with break even. So if you buy in a low implied volatility environment, you're going to be buying an option that's relatively cheap. And because of the mean reverting characteristics of implied volatility, if implied volatility rises, all else held equal, you're going to gain some extra money on top. This option might go from $1.30 to maybe $2. So you made $70 to Vega. Now it's going to be affected by delta. If the stock price goes down and you bought a call, it might start eating away at those gains, right? But still, it gave you an edge that if it were eating away at these gains, it is it's not that big of a deal because implied volatility saved you some of the pain. And it gives you an edge. And if in delta goes your way and you bought a call and the stock price goes up, you're going to make even more money, where this is maybe now $3, right? So options are highly leveraged, and so that's why these are like high multiples of each other. So that's why you want to buy in low implied volatility environments. If you buy in a high implied volatility environment, well, guess what? You're already buying the whole freaking cake. Okay? And if implied volatility shrinks because of Vega and extrinsic value decreasing, your option's price is going to decrease. It's going to start eating into the value of your option, when this was the initial purchase price of your option. Down over here, this is the initial purchase price of your option. So that's why you want to buy in relatively low implied volatility environments and sell in relatively high implied volatility environments relative to the history of the underlying, because it has that mean reverting characteristic relative to the history of the underlying implied volatility. Hope that you learned something from that today. I have nothing to sponsor shill anymore. I've totally given up on that. I'd rather just poop out content for you guys whenever I can. Not saying I don't have a link down below, because I do. But, I kind of decided, there's been a lot of thinking about it. It's like, at least where I am now, it's like, I don't want to do sponsorships. I hate the way they people do sponsorships, or, ask me to do sponsorships. And, I can't handle memberships right now. I can't give enough value. So I think the most value I can give is through making videos for you guys. And so that's what I'm doing. And, it's already in the highest paying section of YouTube. So it's like, do I have to be like ultra greedy? Like this whole encephalitis thing, this brain inflammation thing I'm going through, has really put a lot of perspective on life. I love the money game. I'm not going to lie. It's just fun. It's the points, going after the points. It's fun. But it's even just this encephalitis experience and going through 2022 after, basically being born through a bull market and, through my adulthood. It's helped round me out financially, where, I want an HSA. I'm maxing out contributions to my Roth, that kind of thing. I don't even have an individual brokerage account open right now, frankly, because of the financial situation I'm in because of the encephalitis deal. Now, I could sell some stuff. I could sell these headphones or this monitor. I don't need this big of a monitor or whatever, and open an individual brokerage account. But I'm just slowly trickle feeding my Roth, which is actually, and I'm going to say it, a lot of people are going to be mad about it, but it's actually with Robinhood. I switched over to them to check out their stuff. and see what it's like. And in fact, let's just go over it, because I think transparency is important in the financial sphere. And there's this fear, I think, in the financial sector to not like share everything, because either one, people suck, they don't actually make money across the long time frames, and or two, it's just, you know, people are always going to nitpick and say they do it better. But let's go ahead and open up my Robinhood really quick, and maybe I'll do a separate video covering this. But I just figured I might as well just do it right now because I mentioned it. So we'll go to Robinhood.com. We'll log in. Okay, I'm going to switch scenes so you're not looking at... wait, you probably already are on the right scene. Reminder, appointment, February 9th. Okay. Oh, my authenticator app, huh? So and I'll give you some of my thought process as far as the retirement thing goes. Okay, so here's my screen, and we'll go through my holdings. Because why not? Error loading the chart. Oh, come on, bro. I've been having some technical issues with my computer, so it's probably my bad somehow. Dude. Lame sauce. Error loading the chart. Let me try logging out really quick. I'm going to switch back the camera so you guys can't snoop at my stuff. I've been, I updated my BIOS and it's been hell ever since. Nothing ever works. Let me try something really quick. Hold on. Well, I can't load the chart, unfortunately. It's kind of annoying. Because that's my favorite part. Anyway, I'm up like 10% overall, 20% for year to date. We can just go through my holdings. I have a QQQM. It's basically QQQ. The M on the end is nice. It stands for money in my mind because it's lower expense ratios. Now, it doesn't trade options, so if I'm turned 59 and I kind of regret it because I want to sell covered calls to get out of the positions, that might be a bit of a bummer, but I kind of am going pretty passive with my Roth for now anyway. So QQQM, I have Microsoft, I have Apple, AMD, Amazon, PayPal, VU, a little bit of diversification with VU and QQQM. Not very much like me, but you know, 2022 has changed my mindset towards some things. I got some Meta. My dad sold all his Meta. What a dum-dum. Adobe, and then I have Boeing, I got Nvidia, I got Google, I got Visa, I got Hood. I've made a case for Hood. They're in the earnings call right now, aren't they? Oh, there's no problem loading this chart. Okay. And then I have some Tesla, some QQQ, which is by accident. There was a dividend, whatever, and I have some bond, BND. I mostly am investing in BND, which is a bond fund, because I want to store money in my Roth, but also be accruing some interest while I wait for what I believe is going to be a second downturn. So I have like everything set up so that it's a recurring investment. Let's see if I can show you guys here. Yeah, so here it is, where it's all just recurring once a month, and I can maximize my my Roth contributions that way. So I have it at 33.85. So I have it. So I think that I'll max it out by January. You can obviously contribute to your Roth for the previous tax year up till April 15th of the following year. So I could like contribute for 2022. I think I've already maxed out for 2022. And but this will keep me on track and keep me on target and just kind of trickle feed the markets. Now, what do I think the markets are going to do? I think they're going to have this kind of little party upwards. And then once we have lagging economic data, let's see if I can pull up trading. Now, I'd have to log in because I had a lot of technical issues. But I think we're going to have this little party upward. It's obvious that sentiment is pretty positive because Jerome Powell has not talked about the loosening of financial conditions. And then once we have this lagging economic data come in where unemployment is rising and everything and all that, just the loosening of the job market, the stock market's going to realize that's not very good and it's going to start declining. And then you'll still see the Fed probably pivot at that point, which I would guess is probably the end of 2023. Now, so it could go up a little bit further or stall out. I kind of called a rally into 2023 on my TradingView account down below in the description, and we'll see how long it holds. Next time I'll show you guys my my actual retirement account when the chart is showing. I don't know why it's doing that, but I also, again, have no idea what I did. I tried updating the BIOS, and then it wouldn't boot from any drive at all, and so I had to take an NVMe, plug it into my brother's computer, transfer all the files to an external drive, plug the NVMe back into my computer, install Windows 11 by accident instead of Windows 10, and boot it from that, and then plug in all my other SSDs, and then sort through all my files, and I'm basically having to re-download applications and stuff. And so my computer's not acting completely right. So that could be it, or it could, another reason to hate Robinhood. Did I say I have Boeing? Yeah, I did. Okay, so that's just it. Let me just pull it up on my phone here so you can just see the chart. At the very least, All right. Let me see if you guys can see this. Probably backwards. Come on. There you go. It's up 10% all time. I transferred over from Thinkorswim. I got baited in December, so I'm up, year to date 20%. But I'm also rallying with everybody else, so it's not like anything phenomenal. You noticed I haven't mentioned a single thing about options in my portfolio, and that's because I'm holding off on options until later. I don't think it's quite the right time. Implied volatility is nice and low. But I still think there's going to be a second pullback, and I hope there's a pullback and then a steady period of consolidation where implied volatility shrinks, and then I can strike. At this point in time, it doesn't feel like quite the right moment. You may disagree, and I encourage you to have your own thoughts. I always spew my own thoughts. I don't spew stuff I read or, just copy articles or whatever. Everything I ever talk about is completely OG content. 99% of the time is completely off the top of the head. So that's it. It's in the money. Thanks for watching. Have a great day. Peace out.